1. Randomness matters more than we think. Taleb begins the book with a basic but important truth: randomness plays a much larger role in the final outcome of investment and business decisions than we realize. Many successes and failures are not the result of talent or ingenuity, but simply luck or chance. Key lessons. We often underestimate the extent to which randomness plays a role in events. Investors and entrepreneurs often attribute their success to talent or foresight, when in fact, luck plays a large part. Be careful about being too confident in your ability to predict the future, because sometimes randomness can be the main cause of success or failure. 2. Understand cognitive biases. Taleb points out that cognitive biases are a key factor in how people are susceptible to being fooled by randomness. We are susceptible to cognitive biases such as confirmation bias or recency bias, which cause us to believe that random events are predictable and to make good decisions based on them. Key takeaways. Confirmation bias. People tend to seek information that confirms their existing beliefs rather than accepting contrary opinions. Recency effect. Overestimating recent events, ignoring long-term factors and randomness. Recognizing and understanding these biases will help you make better decisions, especially when it comes to investing. 3. Overconfidence and accidental winners. A large part of the book deals with overconfidence. When investors or entrepreneurs feel that they have found the formula for success, when in fact it is just luck. Taleb calls these accidental winners, meaning people who appear to be successful but are actually the result of random factors. Key lessons. Overconfidence can lead to poor investment decisions. It is important to have humility and understand that not all success comes from talent or strategy, but often from randomness. Avoid overestimating yourself and be aware of the uncertainty in your investment decisions. 4. Manage risk instead of looking for big wins. Taleb advises investors and entrepreneurs to focus not only on finding opportunities for big wins, but on managing risk. Instead of looking for great moments in investing, we should build a long-term and sustainable risk prevention strategy. Key lessons. Risk management is the most important factor in maintaining long-term success. It is necessary to be aware of uncertainty and accept that failures are an inevitable part of the investment process. Invest conservatively, focusing on protecting capital and avoiding excessive risk. 5. Theory of random assumptions and investment strategy. In the book, Taleb emphasizes that randomness cannot be completely eliminated in investment decisions, and therefore, investment strategies should be designed to withstand uncertainty and large market fluctuations. These strategies do not seek to accurately predict events, but to minimize the impact of randomness. Key lessons. Investment strategies should be built with the ability to withstand random and unpredictable fluctuations. Using long-term investment methods and protecting capital will help minimize risks when facing random factors in the market. Investing is not about predicting the market correctly, but about managing risk and protecting your assets from volatility. 6. Why learning from losers is important. Taleb also points out that we learn very little from successful people because they can be random winners. Instead, we should learn from those who fail, because they often face uncertainty and can provide insight into how to manage risk. Key takeaway. Instead of just admiring successful people, learn from those who fail to understand potential risks and how to avoid them. Analyzing and drawing lessons from failures can help you develop a more sustainable investment strategy. Conclusion. Nassim Taleb's Fooled by Randomness is an important book that helps investors and entrepreneurs understand the large role randomness plays in decisions and outcomes in investing and business. Rather than seeking perfection or great success, Taleb advises us to focus on managing risk, avoiding overconfidence, and learning to accept uncertainty. This book will not only help you rethink your investment decisions, but will also change the way you think about success in life.